Okay, so very good morning. Welcome to the briefing for Wednesday the 24th of August. Quick look then at the markets. Things, I would say from a news perspective at least, fairly quiet, so shouldn't take too long to get you up to speed. But thought we would start with the move here, top left, that we had in crude oil, particularly yesterday, and then overnight you've had the API crude oil inventory, so we've seen a bit of movement, fairly large range in crude oil. So yesterday, just before we were kind of wrapping up things, you had that move there in pretty quick succession. We talked about it in quite detail at the time, about those initial source comments that were hitting the tape in regards to, according to OPEC and oil industry sources, Iran is sending positive signals that it may support joint action to support the oil market. Now, that came from Reuters, I believe, first. And was a good example, if you remember, in the news lecture that I would have delivered in your first week about who sees the actual news and from what news terminal can actually define how impactful the news can be. Now, in this instance, you're getting towards the end of the day. It was towards, let's say, 4:30 European close, and the comment itself was a source run on Reuters. But at that time of day, I would say, and given that the industry standard is to have a Bloomberg news terminal, or to at least to view the news, it took a little bit of time actually for the market to really get going on the upside. And certainly, although that was a very aggressive move, it was over a course of around 3 minutes, because Bloomberg were pretty quick to also run it. And then you got a bit of a secondary move, obviously people like us squawking it and covering it, traders seeing it, and it starts to become more powerful in just generally the thinner market conditions. So you had a big ramp up yesterday, managed to get just above 48, but then, as we were talking about as well, when you start to, one of the key things when you have a headline like that, and certainly if you're trading oil in the future, is just be very careful for kind of counter comments when you hear sources, either rebuttals or denials and so on and so forth. And certainly when you actually read the story that Reuters themselves ran, although the initial headlines they snapped were that Iran is sending positive signals that it may support joint action, the actual article said they've not made any decision as yet. So this is just intonating that they may. They've actually not done anything at this point. And certainly the same source went on at the bottom of the article to state that even if they did make an agreement, it doesn't really matter because no one sticks to the agreed targets anyway. So then we started to see a bit of a pullback from those initial highs, albeit we did kind of gravitate towards pivot really and toward the rest of the US session. We did though, however, see another move of significance overnight. Now this was shortly after 9:30. You had a run lower from around, let's say, $48 down around 50-cent move, which is actually quite punchy for the API numbers to really weigh on crude prices that much. Let me just bring what the data showed us last night and run through the numbers. So with the APIs, the headline crude figure, so the one at the top, this is the previous, and this is the figure that came out in the blue from last night. You can see here from the timeline then, the bills was 4.464 million. That was the biggest build in over 4 months. The actual expectation for the headline was for a drawdown of 850,000. Remember, last week we had a drawdown of 2.5 million or so in the headline. Expectations were for a draw of 850,000. We've had a whopping build of just shy of 4.5 million. Hence, that was really your main driver of lower crude oil prices. The other numbers, Cushing, a build of 417,000, gasoline, draw of 2.2 million, and distillates a draw of 834,000, all numbers of which you'll find available in your Hotcom chat. But again, in terms of deciphering which one of the variables is the most important to look at, obviously the headline, as we said before, when all the data drops down, that's usually the one the market reacts to first, but in this instance also taking a bit of further emphasis given the fact that the data set is kind of broken, let's say, the historical range that we've seen or been accustomed to at least the last 4 months, and certainly we've been more used to seeing drawdowns rather than builds more recently, certainly since around, I guess, kind of April time. So quite a big surprise there, and that was your predominant reason then for this downtick that you had around 9:30. We kind of steadied in Asian trade before now we've drifted below pivot. The dollar is a touch firmer this morning, but generally flat. The Dixie trading up around 0.1% at the moment. Quick look at the other charts from yesterday. One of interest being the S&P. New fresh all-time highs, 2191.5. At this point the market still seems to be reluctant to believe the hawkish Fed commentary that we've had of late, that the potential is that we could have a rate hike in September. At this present point though, equities unfazed, and obviously the lower, more accommodative period for longer has certainly been one of the key drivers of equities, and that still continues to lift the markets at this present point. That was around the open when we saw that test coinciding with around, I think it was R2 yesterday. So the fresh high is now 91.5. Most people looking at, in terms of upside levels from here, is 2200 as the next kind of psychological line in the sand. Certainly, depending on what Yellen says on Friday, I wouldn't say that's out of the realms of possibility. To get up to those levels, though, I'd suggest he needs to be pretty dovish in order to, again, give equities another kickstart. Another thing, just looking on equities for this morning, just looking on the top right here, you've got really focusing in on the session seen thus far. So here you can see some pretty choppy price action since the get-go this morning. But what you can see here, this is the DAX, and if I flick it over to the Euro stocks, you can see the same thing. Gap lower, we initially tested S1 and then back to pivot. We've just managed to get above there now to close the gap. This is, I would say, kind of classic summer markets when it's fairly thin from a liquidity volume point of view. You had German GDP this morning, but I think it was the second reading of German GDP. That was in line with expectations. That's not a market mover. What this is just literally the futures gap down. Then you have the initial volatility at the open. The cash equity market then opens at 8. That's when you see that strong wick. That's when the volume spikes, if you like, as that market also opens up. And then you're looking more technically to define the range. I know Ayodeji in the live room took advantage of that. When there's no news, these technicals and these pivots can provide a decent guide. But again, just be mindful, new guys, around these opens of your markets. This is quite typical price movement. Try not to pin news to every single move that you see. As I've said earlier, Vas is going to come on later and give you a bit of a talk on the mic about theories about market randomness, which is something that you need to be aware of, especially during these more quiet summer periods. Just moving on to another piece of news, unfortunate news I should say. An earthquake in Italy has taken the lives of, I believe it was around 10 people the last time I heard the news run on the news wires. But a valid question, I guess, from a trading point of view, and to look at that solely from that angle, was, will it have any impact on the market? And the question is no. The reasoning, how I make those assumptions, is essentially the geographic region of where the earthquake hit is very much centre of Italy. It was in a village type area rather than any major city, but certainly there were some aftershocks felt in Rome. Generally speaking, when it comes to earthquakes, it needs to really happen at the epicenter within a major city to cause mass kind of devastation and destruction. I'm sorry to kind of be doom and gloom about it, but from a purely market sense, that's the kind of level it needs to be to really move the market. So that story not having an impact this morning. Just I've been speaking though, seeing a bit of weakness just coming into the dollar, just back to exactly flat now, so elevating both euro dollar and cable to fresh highs. Cable then trading back up to the 132 handle. Let's have a quick look here on the chart. So if you remember, that was the August 4th when we had that over delivery from Mark Carney and co. We've already really fully reversed most of that move. You'll find Piers has done a latest blog post about his insights. If I actually just bring that up, I do believe he did comment on cable. I've put this link to his latest market forecasts into the chat room, so please do take a read. As a heads up, Piers is going to be on CNBC Live talking on their Street Sign show at 9 a.m, so around 20 minutes time. Quick look at his baseline best case and worst case scenarios on a slightly longer term outlook. Piers says that somehow the global economy or global system continues to muddle through at well below average growth rates, anemic productivity and zero interest rates, but one cannot help thinking that the longer this goes on, the bigger the future storm. Pensioners, pension funds, insurance companies and banks ultimately cannot survive long term under these conditions. So he's pretty downbeat. The worst case in the longer term, large risk materializes in the next 6 to 12 months. There's obviously a couple of key macro fundamentals to look out for. China is still not forgotten. Their economy, of course, is still slowing at this point. The Italian banking system seems to have just been pushed to the back corner at the moment. That was a big driver of the markets only around 4 weeks ago, but certainly the amount of bad debt on their bank's balance sheets is not gone away anytime soon. And then you've had some murmurs about when the Article 50 will be triggered for the negotiations of the Brexit. That's also going to be the negotiations around what shape or form that might take will certainly be a big driver of markets in the longer term. Just to go back to cable though, one thing Piers was saying is that he expects near-term upside bias as it continues to look like the Brexit vote damage to the economy is less dramatic than was feared, and a move back to the 135 handle versus the dollar is likely unless the Fed triggers a surprise SEP hike. So again, quite an interesting take there. He is looking for further upside there. If we do get up to 135, of course, then we're talking about in cable, top left here, that's defining then kind of the range, or the top end at least, of the post-Brexit recovery. Before then we move lower as Mark Carney was promising further easing. Okay, quick look ahead at the calendar then just to wrap things up. Pretty quiet this morning, nothing really too much from UK or Europe to look out for, but this afternoon, looking out for housing data again. Housing numbers were absolutely outstanding yesterday, actually, from the US. I'm just showing you here, this was the US new home sales. This July bar, almost doubling up, or at least adding a third from the prior months. In fact, the highest figure since October of 2007. And we all know what happened around that era. That was just prior to essentially the subprime crisis. So looking here on a 10-year, let me put on a line, it'll make it a bit easier to see. This is where we are at the moment. And this is basically when Lehman Brothers collapsed. This obviously was centered around subprime and the mortgage crisis, so factored on the housing market. And now we're back to those pre-levels. So certainly from a US perspective, jobs looking secure, at least at this point. Again, we've got non-farm payrolls next Friday, that will be key, but housing sector powering on at the moment in the US, so certainly keep an eye out for the existing home sales report. And then obviously Department of Energy crude oil inventory numbers always adds a degree of volatility to the oil price, to look out for those. Okay guys, gonna finish with that, so enjoy your session. Again, final reminder, Piers is going to be on CNBC Live in around 15 minutes. We'll bring it up here on the trading floor on the screens for you. And enjoy your trading day. Thank you.